I'm joined by Simon Derrick, Chief Currency Strategist for BNY Mellon Corp here in London. Hi, Simon.
Good morning.
I mean, the aim of the aid package, although we don't know what it is yet, but in asking for it was to calm markets in Europe. But it doesn't seem to have worked, does it?
I think it's fair to say, given the fact that Irish borrowing costs hit a new record yesterday, and clearly we're seeing the spreads blow out not just in Portugal but in Spain as well, it's not. And I think the point here is that investors are concerned that what we have here is not individual currency crises, but rather something that's structural within peripheral Europe. When we just had the Greek crisis, you could just about argue it was a one-off. But to have two debt crises in 6 months in peripheral Europe tells you that there's a real core cause here. And of course, we all know what that core cause is, that we had inappropriate monetary policy around peripheral Europe for a decade. And therefore, all the nations that have had bubbles or lending booms or sovereign debt booms, as a result of that, are all in the target of investors. And it's not surprising there's no last mover advantage for staying in those places. Better to take a cautious view. The other key issue here, of course, is there's the same root catalyst for both the Irish crisis and the Greek crisis, which was Germany trying to protect its taxpayers by saying it wanted the bondholders to take some of the pain. And funnily enough, bondholders react negatively to that.
I'm not going to say the end game, because the end game could be so far ahead, but what's the next leg of this crisis, do you think, Simon?
Well, I think fairly obviously it is going to move from focusing purely on Ireland to focusing on the Iberian Peninsula. And I do definitely think that Spain, actually more than Portugal, may be the place where people start to focus. And I'm not saying that in terms of the economics of the situation.
Because they're reducing their deficit.
Absolutely.
They've reduced in the first 10 months by 50%. So
totally.
They're doing what's been asked of them.
And we know that they have the funding through to next year, although, of course, that was true for Ireland as well. But there is the concern about the banking system, and there is the concern that they will have high rollovers next year. But the fact of the matter is that people are still fairly highly exposed to Spain. And I think that's the key issue here, that people looked at Spain as a relatively safe bet over the course of the last decade. The positions are still there. And suddenly these concerns about peripheral Europe are starting to build up. So I think people, just from caution, will start to reduce the positioning. The other thing is, and this is maybe a deeper concern, is if you look at what politicians are trying to deflect attention away from, it's about the Eurozone itself. You know, if you look at the two themes that they come up with, it's Spain's not Greece, not Ireland, not... The other one is there's no chance for Eurozone breakup. And it's almost one of those, this idea that never believe anything until it's officially denied.
I mean, we're running a theoretical piece today about the possibilities of Greece leaving the Eurozone. I mean, it's just a theoretical piece, but a breakup of the Eurozone, I mean, no chance.
No chance.
None at all.
None at all. But I think theoretically the debate will take place amongst investors about whether it's possible for one or two nations to leave. And we can all understand that technically we simply can't see how it happens. But if we move beyond that technicality, and we also move beyond we understand the negatives to leaving, you know, the huge debt burden, the fact that these nations wouldn't be able to go back to the debt markets, there are some quite interesting positives. If you're baking in for the long term higher costs of funding for these nations, that's a huge disincentive for staying in the euro, because that's the reason they joined. They wanted the borrowing costs to come down to German levels. Add to that no control of monetary policy, no control of fiscal policy in some cases, no control of currency policy. Suddenly, why are you sitting in the euro doesn't look that attractive anymore.
Thanks to us, Simon. It's going to be long discussed. Simon Derrick there.